Everyone says VOO is the king of long-term investing. But what if a quiet dividend ETF like SCHD is actually building more wealth behind the scenes? This isn't just about price. This is about power of compounding. The real question is, can SCHD's dividends beat VOO's growth? Don't you think? Dividends on dividends, compounding year after year with SCHD might just outrun all that flashy growth everyone's chasing? So we ask the question every smart investor should be asking. Can a slow drip of dividends, reinvested again and again, eventually overpower the unstoppable rise of VOO? And that brings us to the ultimate question. Can the relentless power of compounding dividends truly outpace the mighty growth of VOO? Today, we dive deep to uncover the answer. Here's something smart investors never ignore: fees. A good ETF keeps its expense ratio low. Why? Because every dollar you don't pay in fees is a dollar that stays in your pocket, compounding, growing, and building your wealth. The lower the expense ratio, the more of your money stays invested, working for you instead of being eaten up by high management costs. Over time, those savings can make a huge difference to your returns. VOO and SCHD are both stellar low-cost ETFs, but there's a subtle difference worth noting. VOO, tracking the S&P 500, boasts an ultra-low expense ratio of just 0.03%, making it one of the most cost-efficient funds on the market. SCHD, while slightly higher at 0.06%, still offers incredible value considering its dividend-focused strategy. Over decades, even a 0.03% difference compounds significantly. So clearly, VOO is the choice of ETF to invest in based on the expense ratio. Let's compare the dividend history. VOO has a dividend yield of around 1.3% as of 2025. This means for every $1,000 invested, you earn about $13 in annual dividends, reflecting its focus on large-cap growth companies that reinvest profits rather than pay high dividends. On the other hand, SCHD, which focuses on high-quality U.S. dividend-paying stocks, offers a much higher dividend yield, typically around 3.5% to 4%. That's roughly $35 to $40 annually per $1,000 invested. While VOO emphasizes growth and broader market exposure, SCHD prioritizes income and dividend consistency, making it a stronger choice for investors seeking regular cash flow. Let's compare the last 5 years' return for VOO and SCHD. Between 2020 and 2024, the stock market had a wild ride. COVID-19, recovery, inflation, and interest rate hikes all played a role. Let's break down how VOO and SCHD performed each year in simple terms. In 2020, after a big crash during the COVID-19 outbreak, the market bounced back fast. VOO gained 18.29%, slightly better than SCHD's 15.08%. In 2021, both funds did very well. SCHD actually beat VOO with a 29.87% return, compared to VOO's 28.78%. It was a great year for both dividend and growth stocks. Then came 2022, a tough year. High inflation and rising interest rates hurt the market. VOO dropped hard by negative 18.19%, but SCHD held up better with only a negative 3.23% loss. This shows SCHD's strength during rough times. In 2023, tech stocks made a huge comeback, and VOO jumped 26.32%. SCHD didn't keep up. It only returned 4.57% as dividend stocks didn't perform as well. Finally, in 2024, VOO kept rising with a 24.98% gain, while SCHD did okay at 11.67%. The bottom line is, VOO grows faster when the market is strong, while SCHD is more steady and safer during bad times. In the past 5 years, VOO has nearly doubled by 96.80%, while SCHD gained 51.03%. Early on, SCHD held the lead, but from 2023 onward, VOO took off. Here's the catch. The 51.03% growth of SCHD does not include dividend reinvestments. It reflects price return only, not total return. Since SCHD has a dividend yield of around 4% annually, the actual total return with dividends reinvested over 5 years would be significantly higher. How much higher? We will get to that. If you're wondering whether to go with a growth-focused ETF like VOO or a dividend-focused one like SCHD, let's break it down using the latest performance data. Let's start with VOO, Vanguard's S&P 500 ETF. As of July 23, 2025, it's trading at $583.52 and showing strong momentum. Year-to-date, VOO has gained 8.88%, outperforming its category average of 5.74%. Over the past year, it delivered a solid 16.00% return, again beating the 13.30% average of similar large blend ETFs. But where VOO really shines is in the long-term performance. Its 3-year return is 18.83%, and over 5 and 10 years, it's yielded 16.60% and 13.61% respectively. This kind of consistent performance reflects the strength of the U.S. large-cap market and makes VOO a compelling choice for long-term growth investors who are willing to ride out market cycles. Now, let's turn to SCHD, Schwab's U.S. Dividend Equity ETF. SCHD has a very different strategy, focusing on high-quality dividend-paying stocks in the large value segment. However, its short-term numbers haven't kept pace. So far in 2025, SCHD has returned just 2.12% year-to-date, lagging behind its category's 5.53%. Over the past year, the return is only 5.92%, which is less than half of VOO's. Even over a 3-year period, SCHD has posted 8.32% compared to VOO's 18.83%. That said, SCHD still holds its own over the long term, with a 10-year return of 11.18%, highlighting its power when dividends are reinvested. Let's recap what we have concluded till now. Starting with expense ratio, VOO is more cost-efficient at 0.03%, compared to SCHD's 0.06%. When it comes to dividend yield, SCHD leads with 4.00%, while VOO offers a lower yield of 1.30%. Looking at performance, over the 1-year period, VOO returned 15.13% versus SCHD's 6.09%. For the 5-year return, VOO again leads with 16.60%, while SCHD delivered 12.87%. Over the 10-year horizon, VOO posted 13.61%, outperforming SCHD's 11.18%. In summary, VOO outperforms SCHD across all major return metrics, making it a stronger long-term growth investment despite SCHD's higher yield. One of the most powerful insights from legendary investor Howard Marks is this: history doesn't repeat itself, but it often rhymes. And that's exactly what we're diving into today. If the past gives us any clues, will growth continue to dominate? Or will dividends make a comeback? Let's find out which strategy could win in the future if history does, in fact, rhyme. Let's dive into a future-focused comparison of 2 ETFs. ETF A, which mirrors the growth strategy of VOO, and ETF B, modeled after the dividend-rich approach of SCHD. We're projecting results based on consistent assumptions. $1,000 monthly investments starting January 2025, with dividends reinvested and expenses deducted annually. Let's break down what the numbers are telling us. ETF A, the growth-focused strategy, boasts a 12% annual growth rate and a modest 1.3% dividend yield, resulting in a net annual return of 13.27% after expenses. ETF B, on the other hand, offers a more conservative 8% growth rate with a higher 4% dividend yield, giving it a net return of 11.94%. At first glance, the difference seems marginal. But as we project into the future, the compounding effect begins to show its power. By 2030, ETF A edges out ETF B by just $3,614. But by 2040, the gap widens to over $74,000. And by 2050, 25 years in, ETF A delivers a total return of $2.63 million, nearly $540,000 more than ETF B. That's a 25.8% advantage, solely driven by the higher growth rate compounding over time. So, what's the takeaway? If you're investing for the long haul, think retirement 20-plus years out, growth-focused ETFs like VOO can significantly outperform, even if they offer lower dividends. SCHD-style ETFs, with their strong dividend returns, offer solid midterm value and income. But over decades, reinvested growth tends to win. This analysis assumes consistent returns and reinvestment. Real-world conditions will vary, but it offers a strong framework to guide your investment choices based on your horizon and risk appetite.
All right, folks, if you got value from this video, make sure you smash that like button, subscribe, and turn on the notification bell so you don't miss the next big move in the market. If you're serious about building long-term wealth, you do not want to miss this stock is a winner, happy, hold forever. We're talking about a company that I believe is built to dominate for decades. The kind of stock you buy, tuck away, and let it compound while you sleep. Click right here on the screen to watch it now.